Good morning. You're watching a live daily outlook for majors prepared by Windsor Brokers for date 21st of October 2011, Friday today. The coming EU summit due on Sunday is still the top event awaited as the markets are on hold currently, awaiting the results from the meeting on Sunday. The news that came from basically from Germany, when the German Chancellor Angela Merkel requested to split the meeting into two sessions. The first one will be as scheduled on the 23rd of October. The next one the coming days, but not later than 26th of October, when the outcome of the meeting will be released. So there will be likely no results and news released after Sunday's meeting, but after the second day of the meeting, which will be between Monday and Wednesday next week. The points that are still putting pressure on the market is actually the main one is the division between France and Germany in the way of handling the current bailout fund and the possible increase, as they disagree over the best way to handle the facility, with Paris still fearing its AAA credit rating that they were warned by S&P during the past week. And it comes under threat actually if the wrong method in handling this problem is taken. They had an urgent meeting 2 days ago, and some outcome came, but was not nothing was published. Actually, failure to agree the leveraging of EFSF would further actually damage the confidence in the Eurozone ability to handle its debt crisis after almost 2 years of trying to get on top of a problem that started in Greece and now threatening spreading through to the other big economies in Eurozone, such as Italy, Spain, even France is coming in danger. The important report that came yesterday was presented by German lawmakers. It is an AFSF guideline document which somewhat cleared up the investors' notion about the EU officials' ideas on handling the sovereign debt crisis. According to the document, the European Rescue Fund would intervene in sovereign debt markets instead of the European Central Bank, but to a limited extent. The EFSF would be able to purchase bonds on secondary market if the country has the sustainable debt and respects deficit reduction commitments. This actually triggered the movements in the market. The euro was shooting higher yesterday after announce of the document, as well as stocks. The other thing, a small relief coming from Greece, as the Troika mission that is monitoring the Greece movements in handling the austerity plan. Actually, yesterday the Greek Parliament approved the new controversial package of austerity measures, and Athens is today, as well as yesterday, paralyzed by a general strike and violent street protests. The Troika actually advised to release the sixth tranche of the aid as soon as the agreed prior actions on fiscal consolidation, the privatization, and the labor market reform, which were announced by the government, will be legislated. So the Greece now is moving forward and expecting its next payment in order to cover their debts. However, the focus, as I said, on the Eurozone summit, when we'll have some more clear idea what would be the next movements on the market, now depending also on the decision of the European lawmakers and officials. From today's calendar, some events are due. The first one comes from Germany, where we have the German IFO business climate that is forecasted slightly lower than the previous 107.5. 106.3 is today's consensus, signaling that overall business climate in Germany is declining. The public sector net borrowing from UK due at 8:30 GMT shows also the decrease in the borrowing to 12 billion pounds compared to the previous month release of 13.2 billion pounds. And from Canada, inflation, the CPIs monthly is expected to show 0.1% versus the 0.3% previous month release, while core CPI is expected to decrease to 0.2% versus the 0.4% the previous month release. Now let's take a look on the instruments and see the latest price action of the majors and the commodities. As we can see, the euro remains within consolidative range as shown on the 4-hour chart better after failure to clear the upside barrier at 139.13. However, the short-term bull trend from 131.45 remains intact as long as key support, near-term support at 136.52 stays intact. The pair is mainly driven by fundamentals in past few days by the news without having any clear direction, as the news are following the news are coming and moving the pair up and down without direction. So some supportive news like yesterday's EFSF document release pushed the euro strongly higher, while this morning, after being in the rather narrow range during the Asian session, it's back to weakness. The near-term studies are flat currently on euro-dollar. However, the overall outlook on the near term is still skewed towards the downside, with initial barriers at 138.42, 138.68 holding the upside. First comes 138.32, which is the bear trend line from 139.13. On the wider picture, upside remains well protected at 139.13, the previous high, as well as daily 55 days moving average, and the only break of this level actually might bring some more light into the euro-dollar's price action and the open way for a fresh extension of the corrective bounce from 131.45. Until then, the pair remains capped under 39.00 zone, and on the downside, the main support is 20 days moving average at currently at 135.91. Back to the near term, downside loss of 136.55 support would risk a deeper reversal and opens 136.50 Fibonacci level, 38.2% of 131.45, 139.13. And then we have 135.65 low of 11th of October and 135.26, which is the 50% Fibonacci retracement. On the upside, as I mentioned, the 138.42, 138.68 are the key barriers, before which comes 138.32, the bear trend line, short-term bear trend line from 139.13, above which to expose the 139.13. However, most likely the pair would stay with this within this range until some more news come from the Eurozone, and I don't see, based on the current technical outlook, signal for any stronger movement. Of course, the fundamentals would be still the main driver of the most of the instruments today. The British pound against dollar keeps the near-term positive tone after yesterday's sharp fall through the initial support at 157 level, dipped briefly below to 156.81 where the support was found, and actually keeping the short-term key support at 156.30 intact. While the later stays intact, the focus is still to the upside. However, clearance of 158, 46, 51 previous highs is required to resume higher, as we can see that the pair is still within consolidative range after upside was capped by 158.51. Break of 158.51, upside opens 159.00 round figure resistance, and then 159.40, which is the daily 55 days moving average. On the downside, on a loss of 157, which is our initial support, opens 156.80, and then key support at 156.30 below, which would turn the short-term outlook more bearish and expose levels at 155.60, which is Fibonacci level, and 155.41 strong support, low of 12th of October. Dollar yen is again back to the recent narrow range directionless trading after yesterday's unsuccessful attempt. Higher stalled at 77.08, just ahead of trend line, the main bear trend line that currently stands at 77.15. Basically, expectations from technical point of view, there is no signals of any further action unless either of the extreme points, 75.93 on the downside and 77.15, 77.50, the previous highs zone, is cleared, and that would signal a fresh direction of the pair. Most likely some news from fundamental side would drive the dollar yen into the fresh direction. The dollar Swiss, actually the Swiss franc exploded during yesterday's late US and the overnight session, regaining strength again against the US dollar, as also the Euro Swiss that was projected to stay above 125. That was the decision of the Swiss National Bank, actually stalled at 124.75 and currently is back to 122 zone, which might trigger further action of Swiss National Bank, as they announced after their previous intervention that they are ready to act at any time in order to prevent further strengthening of the Swiss currency. Back to dollar Swiss, the short-term outlook turned to weakness again after upside gains yesterday were capped at 90.81 on approach to 91.20 barrier, and the subsequent sharp decline broke below initial and strong supports at 89.20, 89.00 and 88.80, the previous low, posting fresh low at 88.47. Current bounce on the oversold hourly studies, and basically all of the studies are quite in the overextended zone, is now heading higher, with the initial resistance coming at 89.20 as the first one, and then 89.50 as the next one. However, on the upside, only regain of 90 barrier, that was also the previous strong resistance, would ease the current bear pressure and provide some relief for the pair. However, on the upside, above 90, firm break above 90 actually is required to resume towards 90.80, 91. Until then, the near-term outlook remains quite negative, with the 20 days hourly moving average currently at 89.28, still pointing lower, expected to cap the corrective action on the upside. On the downside, loss of 88.50, today's fresh low, would likely would keep actually the downside more vulnerable for further losses and expose our key level at 87.55, where the daily 200 days moving average stands. The further weakness of the pair is caused also by break of the main bull trendline support drawn from 70.67 historical low of dollar Swiss, and this actually keeps the pressure to the downside for possible violation of 200 days moving average. Commodities, the gold is still at back foot after upside was capped under 1700, 1695, 1700, our initial barrier. Gains, losses so far were contained at above 1600, so above our initial supports at 1595 and 1582, still keeping a recent bounce from 1532 in play and possible scope for further for fresh attack higher. The hourly studies are still in the negative negative territory. However, the flat 20 days moving average at 1620 is still holding the price higher and holding below the price actually, so keeps the near-term action skewed towards the upside. On the daily, the outlook is still negative as the false break through 90 days moving average turned the focus lower, and our initial supports at 1582 and 1595, 1582 come in focus with 200 days moving average currently at 1551. Currently is pointing higher and supporting the price action. However, a break of 1552, the 200 days moving average, to expose key low of 26th of September at 1532. Crude oil is in the near-term consolidative mode after extending gains 2 days ago to 89.66, just ahead of our initial targets at 89.75 and 90 and 90.57. Current pullback is still seen corrective, while initial support at 83.37 holds. However, the 4-hour studies are weakening, and the price below 20 days moving average keeps the short-term tone still more into the negative territory, and focusing the yesterday's low at 84.21 and possible test of 83.37, below which would put short-term bulls from 74.94 on hold and allow for a stronger reversal. Upside break above 86.70, 87 zone is to refocus recent highs at 88.38 and 89.66, and possibly to look for a fresh attack at 90 and 90.57. On the daily outlook for crude oil, we can see that the price is entrenched within 55 and 90 days moving average, with studies regaining strength and the MACD just emerging above the center line, keeping the more positive tone towards the upside favored, as the 20 days moving average is supporting the current corrective bounce. We need to see the clearance of 90 days moving average and the 89.66, which is the previous high, and our key barriers at 90.57 in order to resume higher and possibly focus the 95 zone, where the 50% Fibonacci retracement and 200 days moving average stands.